today, and we'll go ahead and get started. And everybody that registered will get a recording of this, but don't use that as an excuse to go make ramen noodles or mow the lawn or anything. This is going to go over a lot of stuff today when it comes to trust in particular. So we'll go ahead and get started. For those of you guys who don't know me, my name is Stefan Belholm with Prudent Wealth Strategies, College Plan Today, College Tax Planning. Some of you have probably, gone on our YouTube channel or seen some of our emails or gone to a workshop in person or online or one of these webinars. A lot of you probably familiar with these blueprint kits, these tax planning, these college tax planning blueprint kits that we offer. So this workshop, this masterclass is really we're going to be diving deep into trust in particular and how to use these specific type of trust, family trust in detail when it comes to college funding. Obviously, college is a very huge expense. And, if there's a way to reduce that, then hey, why not, right? So we'll go ahead and get started. Now, a few disclosures. Want to let you know that nothing in this presentation should constitute tax, financial, or legal advice. So don't assume anything here applies to you specifically. This is really just for informational purposes, and hopefully you guys enjoy and take part to a lot of the information we're going to go over. So a few housekeeping items. This is a 90-minute masterclass. Your questions are welcomed and encouraged. If you've ever been on one of my calls, you know that I do kind of like to talk, but I like to hear and learn from other people, and I enjoy your guys' input. So I might put you on the spot. So just feel free to kind of voice your thoughts or have any questions that you have. You can also type those in the Q&A. My wife, Michelle, who's also my business partner, is not on the call with me today. She's on a field trip with her son. So today I'm going to be manning everything by myself, which I'm not really good at. So just kind of deal with that. But make sure type your questions in. I'll fill those out at the end. This is really a jam session. I'm going to try to hit everything as much as possible during the call. And if you want to talk, just raise your hand. I should be able to see that to unmute, and we can kind of take it from there. All right, so quick background on me. My name is Stefan Belholm. Again, I'm a tax strategist. I'm out of Pinehurst, North Carolina. I'm originally from Florida, been in North Carolina for about almost 8 years now. We love it up here. And basically what I do as a tax strategist is I'm in Pinehurst, so I'm not sure if anyone on the call is familiar with golf, but we are having the US Open coming next month, which we're super excited about. Because there's going to be a lot of famous golfers out here. Actually, Stephen Curry and what's his name? The guy from Hootie and the Blowfish. I can't remember his name. Darius Rucker. They're going to be out here, I think, next week or the week after for some events. So we're super excited. Anyways, so that's where I live. I'm in North Carolina, from Florida originally, but we have clients all over the country. And basically, I work with CPAs, tax attorneys, and specialists that help business owners and property owners and investors all around the country when it comes to these specialized tax structures. So that's mainly our focus. That's mainly who, the clients that we work with. So we work with them on the tax planning side. This in particular, what we're going to be talking about today is the college side, because when you kind of understand how college funding works, it's really just tax planning in reverse. And specifically, we're going to be talking about the trust today, family trust. So one thing to understand working with us, you can keep, whoever you work with. We're not here to break up any relationships that you have with your CPA, your lawyer, financial advisor, or whatnot. We're not trying to interrupt anything. We're really trying to enhance and make what you're doing a lot more efficient, a lot better. So you don't have to, make a whole lot of changes. You're just going to be doing things the same way when you kind of understand how these trusts work, with some minor differences. The main thing is to understand the difference between expensing and taxable distributions. Okay, and this is going to be a key concept we're going to be going over as we go through this. And we love working with money managers, and they tend to like us because we give more money to manage, because obviously less taxes, more money you have, more money you can grow your wealth with. And that's kind of the whole concept. So we deal with specialized tax structures from special purpose vehicles, charitable trusts, donor advised funds, holding companies, all of these different tax structures to help our clients when it comes to their businesses or their investments or real estate or whatnot. Today, specifically, again, we are going to be talking about trust, but in particular, the family trust, because there are different types of trust. And otherwise, this would be literally an 8-hour jam session. So the agenda is really going to be going over how a properly structured trust, and that's the key thing to understand, properly structured trust can not only reduce your taxes on anything. It doesn't matter if you're doing, you have a business, an LLC, real estate, investments, crypto, you're a contractor. We work a lot with real estate agents. You're a 1099 contractor. Hey, there's not a whole lot of expenses that you have at the end of the year. What can you do? This is where the trust can help. And obviously, because we're talking about college, and college is just a super huge expense, these strategies, these trusts are going to allow you to fund college on a pre-tax basis versus after tax, which is obviously much more efficient. So we're going to go over that. We're going to go over why trusts are more efficient than traditional structures and strategies, whether it's 529s, Roth IRAs, when it comes to college funding. Now, if you have a 529, don't take it and throw it in the trash in the backyard or anything. It's fine. It's just what can we do to be a little bit more efficient? So hopefully I want to open your eyes, open your mind a little bit into, looking at things and doing things differently. So we're going to go over that. We're going to go over how trusts work. And then most importantly, hey, if this works for you, if this is something that you think is going to work for you, or maybe a family member or friend or someone that you know at your church or synagogue, whatever, how this can happen very quickly. I mean, we're about not only giving the information, but showing you guys exactly how to implement this stuff. And that's really what gets me excited and, the funnest part of my job, if you will. Now, I will say trusts are not for everybody. Okay, this is not for everybody. I'm not going to make any bones about it, about saying, hey, this is something that's a one size fits all. At the end of the day, there's a lot of people I talk to, and this just does not work out for people. So just kind of understand that as we're going through this. Now, there's a big difference between tax avoidance and tax evasion, right? One is legal, one isn't, right? If you're not reporting income, you're not reporting, deductions the right way, you're concealing stuff, that's illegal. You're going to go to jail, and we don't deal in that. The IRS has a whole slew of different things, from the dirty dozen to listed transactions to documents like these, recognizing illegal schemes. That's not what we're about. We're about tax avoidance, which if you've ever seen this right here, if you go and work for the IRS and you become an auditor, one of those, thousands of people that Joe Biden just hired a few years ago to start, auditing people. This is the handbook they give you. And in this handbook, it says clearly, tax avoidance is not a criminal offense. Any attempt to reduce, avoid, or minimize or alleviate taxes by legitimate means is permissible. And so that's what we're about. We're about showing you how to legally reduce your taxes by using tax avoidance. And if you just Google tax avoidance versus evasion, you'll see the IRS has a whole bunch of information. They have a document that says it's perfectly legal. So I really want to let you guys understand what we're trying to do when it comes to these strategies and these structures. Now, there's a famous quote from a guy named Billings Learned Hand. If you haven't heard about him, Google him. I think it's the coolest name ever, Billings Learned Hand. Like, that's super cool. But anyways, one of his famous quotes was, in America, and I believe this truly and fully, not just from a tax perspective, but for a lot of things in life, there are two systems, there are two tax systems, one for the informed, right, and one for the uninformed. Both are legal. So it's not what you know, it's what you don't know sometimes. And a lot of people make the mistake of doing things a certain way when it comes to taxes. And it's just ridiculous, because the most of you, I imagine, have good CPAs. Okay. My dad is an accountant. He's been an accountant for the past 30 something years. Okay. And most CPAs are good at filling out forms, deductions, monitoring deadlines, all that stuff. That's, what a typical CPA does. What they're not good at is being aggressive, being proactive, taking charge, and doing things differently. And that's because most CPAs by nature are just bean counters. It's not a slight on CPAs or anything. It's just kind of how they're wired, how they're trained, the schooling that they go through and everything. So accountants are generally not, very proactive. They're just very reactive. Hey, what did you make? What's your deductions? This is it. Maybe you can go buy a truck or, put money in a retirement account, but that's about it. They don't really explore for the most part. There are obviously some CPAs and accountants out there that do that, but few and far between. So there's a big difference between kind of what we do, the planning side, hey, saying what we can do to strategize, to optimize, to reduce your taxes versus saying, hey, what can we do at the end of the year? We're having conversations with our clients in January. I cannot even believe that it's, almost halfway through the year, right? We're almost in Q2, end of Q2. And, for a lot, the work that we do is just so proactive. And I'll get into that in a little bit when it comes to college, because you have to be ahead of the game. If you have a kid, if you have a student that's in their junior year, going to their senior year, your goose is cooked. There's nothing we can do. That's just the nature of kind of how this stuff is done. But if your kid is class of 2026, they're going into their junior year. If you have a student like that, or you know someone, you really need to start understanding how this stuff works now. You really don't have a lot of time. So you have to be proactive, not only on the tax side, but on the college funding side as well. So this is kind of how most CPAs, deal with stuff. They have thousands of different tax returns, personal returns, corporate returns, extensions, this and that. And there's so much stuff in the tax code, okay? Different sections and areas, and no CPA, no accountant knows the whole thing, right? They usually, if you look at the big firms, the KPMGs, things like that, they have departments, they have different people that specialize in stuff. So the thing I want you to understand is that, again, you don't know what you don't know, but this is the reason why a lot of businesses, most businesses overpay on their taxes, and the average effective rate for a small business owner is about 20%. Okay, it's just that simple. But, right, we see all the time on the news, right, all these companies that don't pay any taxes legally, right? The Apples, the Googles, the FedExes, right? General Electric, Verizon, Amazon, right? These companies make billions of dollars every year and they don't pay any taxes legally. Why? Because they know how to use the code and they know how to take action. So that's what we're going to be talking about. But specifically, we're going to be talking about it from a trust perspective on how to use tax structures, because most people aren't familiar with how to use trust from a tax perspective, right? From a legal perspective, hey, I want to avoid probate. I want to make sure all my assets pass to my heirs the right way. That's one thing, but not from a tax standpoint. So we're going to kind of unpeel and demystify a lot of that stuff. Warren Buffett, right? He pays less taxes than his secretary, lower tax rate, I should say. It's very misleading. A lot of people don't know that. But so going to college, right? College ain't cheap, right? If you're a parent and you've gone through this before, you probably know that. I'm going to stop for a second here and open up the panel and ask anybody. Does anyone raise your hand? Have you gone through this before? Have you gone through the college planning funding process? You filled out FAFSA, looked at colleges, anything like that? Has anyone ever done this before? Or are you all first timers? Anyone? Raise your hand. Okay, so Rita, Anthony. Okay, Anthony. I'm gonna open it up for you, Anthony. Can you hear me?
Hello. Yes.
Hey,
Yes.
Anthony.
How are you?
Good, good. So you've been through this before.
Yes.
Can you tell all the folks how great it is?
It's a lot of fun.
It's a lot of fun, right? Having to go
Yeah.
through the FAFSA and the CSS profile and fill this out and that out, right? It's a lot of fun. Obviously, you're big facetious as I am, but yeah, that's college is not cheap, right? Where I live, Duke is around 80, almost $90,000 a year, and that's now, and that's not counting tuition inflation, which who knows that. So over 4 years, that's like $355,000, and that doesn't include pizza money, beer money, and all that other stuff. So you guys are all know that college is not cheap, not like it used to be, 30, 40 years ago. But the difference is to some people, and I get this all the time, I talk to people all the time, but you have to understand to some people, that amount of money is pocket change. It doesn't really mean anything to them. It's a drop in the bucket. And that's why, obviously, if you've seen, the college admission scandals, the Lori Loughlin's, the Felicity Huffman's of the world, these people are paying that amount of money, right? $500,000 just to get their kids in, right? They're not talking about reducing college costs. They don't care about that. And there's plenty of, and believe you me, there's this type of stuff. If you watch that thing, it's still going on. It's not going anywhere. They just got caught. Okay. So that's the reality. But the point is, there's people that this amount of money, it's not a big deal. International students, where do you think colleges get a majority of their money from? A lot of these, especially where I live, Chapel Hill, they love international students, love out-of-state students, because what? Who knows why? That's right, Jerry said, yeah, they make more money, right? That out-of-state tuition. So yeah, so this is kind of the thing to kind of understand. And most of the big schools, the elite schools, they don't give merit scholarships. Because why? They got all the smart kids from not only here, but from around the world. So they don't give merit scholarships. It doesn't matter how smart your kid is, but they do give need-based financial aid. Okay, we'll peel back that, and Anthony, you've gone through that process before, so we'll go over kind of detail how this works with the trust. But that's the thing to understand. So if you don't make a lot of money, right, and you're sending your kid to one of these schools, right, there's lots of financial aid. But if you own a business, if you have real estate, you save for retirement, right? You paid off your house, all these things that we think are responsible. Guess what? This is how it is at the colleges, right? Would you agree, Anthony? Would you agree with that?
Yeah, colleges are definitely trying to get all the money they can get.
Yeah. Yeah, it's that simple, right? So you own a business, you make money, you're a real estate investor, whatever, you must be rich, right? It must be for you every day, like money's just raining from the sky. But anybody that's been in business for themselves for, any good amount of time knows that it's not like that, right? It's not like that every day. So for their perspective, you make money, hand it over, that's it. But every day that you walk into what you're doing, right, you're taking on a huge amount of risk, right? COVID's a big example of that, right? I don't know about you guys, but I was freaked out when COVID first hit. And it's not just from a business perspective, it was from my life perspective and my family and all this stuff. And, adding a business on top of it's another complexity, right? But, as a business owner, you have all of these different expenses, inventory, payroll, right? And now because of inflation, the Inflation Reduction Act, thanks, Joe Biden, all these things cost more money. You have debt, lines of credit, legal issues. Just had a client last week. He's going through, we got his trust set up. Thank goodness, right before he didn't even expect this. His business partner's trying to sue the crap out of him and steal money. But thank God we had the trust set up. But yeah, legal issues, business disruption, right? Who thought AI would change how we do business? I didn't think that 3 years ago, right? But all these different things, taxes, obviously, right? The taxes you pay, federal tax, state tax, capital gains, all these different things. So there's lots of different things you have to deal with as a business owner. It feels like whack-a-mole half the time. But guess what? From the college perspective, they don't care. You make money, you have more than a lot of other people, so that's it. So the thing to kind of understand here is that as much as, and I think most of you guys on the call, and I'm not here to have the whole debate of, whether a college degree is valuable or not. My oldest is at UCF right now. So just from a personal standpoint, I can tell you, I've gone through this myself. My oldest is in college right now. Not my middle child, I just can't even believe it. We just did ninth grade orientation a few weeks ago, and then I got a son. So I'm dealing with this stuff. I've been doing this for a while, but it's really helped me. It's a different thing when you're doing it personally, and I understand it, and I've been through the dynamics. But I understand the business side of college like you wouldn't even believe. And most people, they make that disconnection just because it's the next step in life. They want the best for their kids, whatever. But again, you got to think like a business owner. You got to think entrepreneurial when you're going through this process. So college is a business, but it operates much differently than your business, right? In your business, you pay taxes, but colleges are tax exempt, right? They have that 501c3 status. Your money, when you pay that to the college takes that money, they put it in their endowments, they invest in oil and gas, stocks, real estate, whatever. They don't pay any taxes. And then they give that money to some other kid, not yours, because again, if you make too much money, that's that's it. And every college, and just so you know, I'm from Florida. I don't know. Is anyone from Florida here? You have any Floridians?
Grew up in Orlando.
Oh, you're up in, oh, okay. So I went to Rollins. So
I used to skip class and do my homework at the Rollins Library. I graduated from Winter Park High School.
okay, awesome. So that's cool. So Winter Park, so I used to Austin Rivers used to play at Rollins, and I was like, who's this scrappy little kid? Like I didn't know who the heck he was. Next thing I know, he's in the Avian. I'm like, oh my gosh, that's Doc Rivers' son. But that's really cool.
Where
So
Mr. Rogers went.
yes, Mr. Rogers, exactly. So me and Mr. Rogers are the most famous people from Rollins. But yeah, but I mean, any school you go to, University of Missouri, High Point, where I live in North Carolina now, Rollins, they all look like country clubs, right? And so it's a big money grab, and again, it's a business. And you're going to hear me refer to what I call the system, okay? And I'm not big into like conspiracy theories and stuff like that, but this is just like basic economics, okay? Between the colleges and the IRS and the College Board, the FAFSA, the Department of Education, it is a system. It's a system that's designed to keep the college system going. And you have to understand that. And from a tax standpoint, right, when we start looking at taxes, your tax dollars are already funding educational things, right? The Pell Grant, SEOG grant, student loans. Student loans is the biggest part of, the federal government's got a love-hate relationship with student loans because it costs them a lot of money. But since 2010, they've kicked out all of the private lenders for the most part. And so they're making that money, that interest money. Most people don't know that that's a huge income earner for the government is student loans. So and on top of that, you have Biden who has plans, and I'm not here to get political, just so you know. I tell people all the time, I'm not a red guy, I'm not a blue guy, I'm a green guy. I'm about green and keeping as much green in my pocket and hopefully your pockets as well. So I just want to let that be known from the outset. But the point is, Biden, he's got all these different plans, the American Families Plan. I mean, how could you say no to American families? That like you have to be a jerk to not think to poo-poo on that. But this plan is, $109 billion to make 2 years of community college free, 80 billion to increase the Pell Grant by $1,400, which I don't know how much $1,400 is gonna, impact, the already, over expensive cost of college. $62 billion for retention and completion programs for some of these colleges that already have low graduation rates. And they just forget, I don't know if you saw this on the news, they just forgave, $6.1 billion in student loans for stuff. So the question is, who's going to pay for this? Take a stop break right here. Who do you think is going to pay for this? Any guesses? I think you guys are smart, right? It's us. It's the American taxpayer that's going to pay for it, right? Biden's got all these different plans, and beyond that, right? The Inflation Reduction Act, right? I love how the government comes up with these terms and these words and acronyms. It didn't reduce inflation, it didn't lower any costs, and it just caused higher taxes. I don't know about you, but every time I go to the store, it's like 50, $100 just for milk and bread. So that's what that's how the government makes money, right? The government doesn't really produce anything, they just tax us to death. Capital gains. Most people don't know this. The government has a lot of capital gains. All you have to do is just Google capital gains, IRS. And there's tons of bills out there, but they collected $500 billion in capital gains taxes in 2021. And they have plans, they have projections to collect even more over the next decade. And they're very calculated in how they do it. So if you're not proactive, if you're not looking at this stuff ahead of time, and that's, I think, really what separates the average person, the average business owner, investor versus someone who's says, hey, let's take a more proactive approach, you're going to get burned. So this is, and I really want to focus on this for a second. I'm going to go into a lot of stuff with the trust. I'm going to go into a lot of stuff. And again, I'm going to open it up for Q&A. I want you guys to be engaged, but I really want you to kind of understand the mindset and the difference of, okay, should I be doing things here or should I be doing things here? Because at the end of the day, like I said, trusts aren't for everybody. So if we look at the tax brackets of the median household, right? The median household in America, okay, it's about 61,000, right? And then the top 1% is about 480,000. Like now, and I can tell you, most people that I talk to, I have a lot of friends that are like doctors and stuff like that, and they make, good money, seven, 800, $900,000 a year. They don't think they're in the top 1%. They think the top 1%ers are those multi-billionaires. But this is the reality. The reality is if you're making over $480,000, you're in the top 1%. So you might say, hey, let's go tax and get those 1%ers. But guess what? You're one of those 1%ers. That's just basics, economics. These are just facts. So my question, and I'm gonna raise this to everybody. What do you think it takes to be in the top 10%? Not the 1%, not the 5%, the top 10%. What do you think it takes to be in the top 10%? Let me see who's got some hand raised. Any guesses? Melissa says 300. Nope. Dan, what do you think?
It's about 74.
74? I wish you were right. I wish you were right. Close.
76.
Nope. 140. 140. That's what it takes to be in the top 10%. Just that amount of money. Okay. Now, again, most people I talk to, they sure as heck don't think 480 is in the top 1%. But when I tell them 10%, they're like, whoa. And so again, when we start connecting the dots when it comes to the trust, the FAFSA, the college, all this stuff, the system, you have to understand if you make over $139,000 a year, you're wealthier than 90% of the population. It's that simple. You may not think it. And again, I live in North Carolina. So when I lived in Florida, obviously costs were different. In Florida, they didn't have state tax, but they get you other ways, right? They get you on property tax and everything else. But most people that I know that make 150, and I think Lori said 150, so you're close. But you don't think you're wealthy. You don't think you're not driving Lamborghinis, right? You're not, vacationing in Switzerland every winter. But that's the reality. So if you make over this amount of money, you make more than 90% of the population. That's government statistics. That's how they look at everything. And if you're wealthier than 90% of the population, you definitely need to be doing things differently than 90% of the population. It's just that simple. So using a trust structure is that difference. And we're really going to get in depth and talk about that. But hopefully you guys are in the right frame of mind. Any questions about anything so far? I think most of you guys had a few questions. You see, Dina, can I use a trust if my husband is a non-resident? Yeah, we'll get into that. There's different things, but we'll get into that. All right. So different types of trust, revocable trust, charitable trust, special needs trust, all this stuff. For the purposes of this workshop, of this masterclass, we're going to be talking about a family trust structure, also known as a dynasty trust. There's lots of different terms of it, but these are what are called ongoing trust or irrevocable trust. So if you have a living trust or know someone that's had a living trust before or whatever, this is a completely different ball game. So basically with financial aid, and Anthony's been through this, but financial aid is very simple. I'm just going to break down I don't want to go into, we literally could spend hours on the different dynamics of the formulas and how it works, but you basically have two different types of aid. You have merit aid. It's based on the grades, GPA, test scores, all that stuff, and need-based aid. We don't delve into merit aid. That's not our forte. We have some people we could refer you to if you have questions or need some help with that or whatever. But our focus is on the need-based aid, which is math It's based on finances, income, and assets, and that's it. Now, if you're going through this process, Anthony's gone through this process already. The result essentially when you're going through college is every college, like I showed you, Duke's about $90,000 a year. They have this formula called the EFC, or expected family contribution, which is basically a deductible. That's the easiest way I like to explain it. And it basically says, this is what we think you can pay for college. This is what the system, right? The colleges is the government, the FAFSA. This is what we think you can pay for college. Not what you think you can pay, but what we think you can pay. And just like taxes, unfortunately, it's only their opinion that accounts. And if you look at the financial aid forms, it's very similar to taxes. And that's kind of how I got into this whole world, is when I started learning about all these different, college funding strategies and stuff like that. It's really just tax planning in reverse. Okay. What's the difference? So the basics of the formula is basically they're looking at all your income, parent assets. They give you some allowances. So for parent allowances, I think this year it's maybe $20,000 or $30,000 or whatever. I can't remember. But they say, hey, this is how much money we think you can have. After that, we're going to give you a tax rate of about 47%. Most of the people we talk to, they're at that tax rate for EFC. Your assets. So the colleges say, hey, we think you can keep $10,000 in your name. That should be okay for you. But anything after that, we're going to assess at about 5%. Student income. The student, if your student has a summer job or any type of income, they can earn about $7,600. And then after that, we're going to tax that income at over 50%, about 50%. So, because goodness, if your kid's working and earning money, what could they, save that for? It couldn't be for a car or, for down payment on a house one day or for their future retirement. It shouldn't be for that. It should definitely be for college. So that's how the colleges look at it. And then any assets, same thing. Student has assets, they're going to tax that at a rate of about 20%. And so that's the 30,000-foot view of the EFC formula. I don't want to get into the specifics of it. They just changed the formula, the wording to SAI, or Student Aid Index. It's basically the same thing, but this is your deductible. So just to give you an example, if your family, let's say you made about 200,000, you had about 200,000 in the bank or in your investments, you paid your kid through your business, which a lot of people think is a smart thing to do. We'll go over why that's not that smart. And your kid's got $20,000 from grandma and grandpa. This is how much the colleges think you can pay for college. This is how much the system thinks, rather, you can pay for college. 75 grand. That's how EFC works. It's unfair, but that's how it works. So what counts and what doesn't count from an EFC standpoint? And this is where we really start to peel back the layers and understand how this works, specifically from a trust perspective. So they're basically looking at all your personal income, cash, CDs, stocks, 529s for all the kids, Coverdales, prepaid 529s, and business assets. This used to be a thing of contention because you used to be able to, on the FAFSA side, again, I don't want to get too deep in the weeds, but if you had a business and you had a small business, there was basically a small business exemption, you had less than 100 employees, they didn't count any business assets from a FAFSA perspective, which is pretty much every school in the country. They got rid of that, okay? So that's what they're looking at. All the schools are looking at that. And then any real estate that you have, minus obviously if you have a debt on it. Now, what doesn't count is your home. Generally speaking, your primary residence is not going to count as an asset. There are some schools that will look at that on the CSS profile. It's a different form. Again, not going to go in the weeds, but loans don't count. IRAs or 401ks or any other type of retirement plan. So, any type of pension or TSP, thrift savings plan, whatnot. Any ERISA-based retirement plan is not going to count the asset typically. Health savings accounts, life insurance, cash value, annuities, and then certain trust estates. And so that's where we have to start peeling back the layers of the onion and saying, okay, wait, does this make sense for us to do this? Not only from a tax perspective, which we're going to get into, but from a college perspective, because the colleges aren't looking at this information. And why this matters, again, like I said in the beginning, is because you don't have a lot of time. my daughter's going, the older my kids get, the more I get into circles of older parents. And oh, sorry, Dan, did you have your hand raised? Sorry.
No, I didn't.
Oh, it's raised. You just want to drop that down and might have just left it down. So,
Oh, do I have to unmute it or un
or just
unraise
unraise it.
Okay.
I
Oh,
guess there's a
lower
button.
hand.
Yeah,
Okay.
lower hand. There you go.
Sorry.
I apologize. I just caught on. All right, cool. Anyways, but the reason why this matters from a time perspective is because, again, everything now with financial aid, it used to be, you're doing stuff in your senior year and they're going to look at that stuff and then you have to do it again. That's how it was years and years and years ago. Then they switched to a prior method, which basically means they're looking at the tax return of your students' junior year, December 31st of your student's junior year in college, in high school, rather. So what does that mean is that if you have a student that is in high school and they're going into their junior year, so they're a sophomore going into their junior year, this is the year that counts. This is the year that we need to be looking at optimizing and strategizing to maximize potential eligibility for financial aid. Now, not every school is going to give financial aid, right? If you're looking at a state school, like my oldest is going to UCF, they don't give a lot of financial aid. It's a good school and it's a lot cheaper than going to Duke, but that's a whole other conversation. But the whole point is you have to be proactive. So this year is the year if you have a kid that's going into their senior year, again, class of 2023, they're looking at the 2023 returns. So that's I'm sorry, not class of 2024, 2025, sorry. They're looking at the 2023 returns. So next school year in the fall, your students will be filling out the FAFSA and it's going to be based off the 2023 tax returns, which there's nothing we can do. So there's no such thing as being too early. There is such thing as being too late. And if you have kids in high school already and you didn't know that, hopefully you know now. And if you know anyone else, get on the phone, email them, text them, say, we got to get stuff going now because there's a lot of really cool things that can happen. And I'm going to go into that. So the key concept is by being proactive, and we'll talk about the specifics of the trust, but being proactive is number one. Number two, using a properly structured trust, not only can we mitigate the taxes, which is hella cool, but we can legally remove income and assets from the EFC calculation. Okay. And that's really the key concept that I want to drive home when it comes to all this. Now, for those of you guys who aren't familiar with trusts, what is a trust? A trust, Black's Law Dictionary, I want to just keep it very simple. It's just an entity. It's just a holding. It's literally just like escrow. Okay. So Black's Law Dictionary defines a trust as an equitable or beneficial right or title to land or other property held by one party for the benefit of another. The trustee holds the legal and equitable title to the property for the benefit of the beneficiaries. So the trust is essentially a silo for beneficiaries. It's when things are in a trust, it's actually, we like to say, hold on. Now this is getting really dry. We like to say own nothing, control everything. We'll get into that. But technically, the trust does not even own any assets. It's just it's held in trust for the benefit of the beneficiaries. Because one day that person could dissolve that trust, terminate that trust, say, hey, I want to take all these things and put it in my personal estate. And we'll get into that. But that's all a trust is. It's just an entity. It's a holding pattern. It's escrow, whatever you want to call it. Different parties to the trust. You have the settlor, which is basically who creates the trust, who sets up the trust. It's also known as the grantor or creator or trustor, and that's who establishes the trust. Then you have the trustee. That's the person or sometimes a financial institution, like banks do it. There's some attorneys' offices that are trustees for people's different trusts. We're managing entity, and they basically hold the legal title in the trust for the trust estate. So everything inside the trust is considered the trust estate, and the trustee is the person that basically manages, controls, and things of that nature. Okay, so the trustee is basically the one that has the most authority, if you will, when it comes to the trust. And then the beneficiaries of the people or entities, because it could be, a church or a synagogue or mosque or school or whatever, a college, right? Colleges love. I'm actually going to be speaking at a college, won't say the name, in North Carolina next month because one of the deans actually likes this strategy for their endowments for some of their people. But yeah, the beneficiaries are who gets the money from the trust estate. Okay. So the way to, this is the Holy Trinity, if you will, understand this is the grantor sets up the trust. They're establishing and funding the trust, because if the trust isn't funded, it's not really valid. And there's so many people that I talk to that have trusts, not like this, but even living trusts, that they don't even realize that the trust is not valid. It's literally like a paperweight because it's not funded. So that's the main thing to understand, is that the fund has to be, the trust has to be funded to be considered valid. But the trustee is the one who has the ultimate control. And then the beneficiaries, again, benefit from the trust estate. Okay. Now, the problem with most trusts, and we're going to really start nailing down and going into detail when it comes to some of these things and concepts, especially when it comes to college. So we're looking at the tax side, we're looking at the college from the same lens. 99% of the trusts, most of the trusts in the US, use the simple tax code. And what that means is that if it's a trust, and I'm not talking about a living trust per se, or a grantor trust that most people have, because most trusts don't file tax returns. If you're just using a basic trust just for, hey, I want to make sure my kids don't have to deal with probate or anything like that, you're not going to file a tax return. Okay, but most trusts that are taxable entities or family trusts, fall in that realm, and we'll break down kind of what that is. They require a distribution of income and assets. They use a simple tax code. And when it comes from a college standpoint, this is what separates these types of trusts from the typical trust. So that's the problem with most trusts, is they use a simple tax code, requires a distribution, which means what? You're going to pay tax, right? The trust or the individual is going to pay tax. And again, that's understanding how the college system works, because what are they looking at? They're looking at your income, okay? Looking at taxes. So that's problem number one. Problem number two is 99% of the trusts are set up as living or grantor trusts, which means that the trustee can revoke, they're also known as revocable trusts, can revoke the assets back to the personal estate. So for all intents and purposes, a living trust or grantor trust is still considered part of your personal estate. It only becomes part of the trust estate when you die, when you're no longer here, which is, again, great because we get to avoid probate. Right. And if anyone's gone through probate before, it's not fun, not cool, any way, shape, or form. But that's really the only benefit with those types of trusts. And then the third thing, which is probably the most crucial thing, especially from a college standpoint, tax standpoint for sure, but definitely from a college standpoint, is 99% of the trusts in the US are statutory. Okay. They're part of legislature. They're creatures of legislatures, like LLCs, like corporations. So you don't get the same asset protection benefits, number one. Number two, the colleges are going to look at it. So they're creatures of legislature. They're not part of contract or common law. And that's something that's very, very important for you to understand when it comes to these trusts. Most trusts, and I want you to understand this, because again, like I said in the beginning, this is for informational purposes only. I'm not your attorney. I'm not your CPA. I'm not your lawyer. Don't go out there saying, "Oh, Stefan said if I put money in a trust, I don't have to report on financial aid." That is not true. Okay, you absolutely have to report trust on the financial aid forms. Caveat is how your trust is set up. So most trusts are not protected from the FAFSA or CSS profile calculations. Living trust, revocable trust, grantor trust, charitable trust, special needs trust, they're not protected. You're going to have to report those things on the formulas. The only trusts that are exempt, this is the key thing here, is number one, if the trust has been frozen by a court order, which is few far in between, but it does happen, okay? Or if the existence of the trust is unknown to the family. So if we don't know we have a trust, how can we report something that we don't know? So the colleges and the government understands that. But the third thing is, if the beneficiary's receipt of trust funds is to be determined, meaning that, hey, there's no determined and decisive receipt of trust funds at any point in time for beneficiaries. So the key concept here is to understand that any trust, okay, that pays, credits, or requires a distribution where the parent or the student, okay, because a lot of people will say, oh, we'll put the students, it doesn't matter, or grandma or grandpa, it doesn't matter. If the trust pays credits or requires a distribution, or where the parent or the student is the beneficiary of that trust, it must be reported on the CSS profile or FAFSA. That's a fact. Take it as you will. So when we're using the family trust structure, this puts you in a much different position because we're using the trust estate much differently, okay? We're using the trust estate for basically expenses. We're living out of a trust as much as possible. This is the whole, trust fund baby. We'll get into that. But that's how these trusts are set up. So you use your personal estate basically for your taxable distributions. We're not using the trust estate for taxable distributions at all. And that's what makes this work from a college funding standpoint. So, and again, this is where the whole trust fund baby comes from, right? If you know anyone, and quick story, I like to tell people I never learned about trust in college, but it's kind of a lie because when I was in college, there was a really cool buddy of mine. He lived in my dorm. Really cool guy. I'm not going to say his family name, but let's just say they sell beer. Okay. And we got pulled over one night and, we're just being crazy. We weren't drunk or doing anything stupid, but we're being stupid. Anyways, I'm in the passenger side. And obviously, first thing comes to mind for a lot of people is crap, you're black, something's going to happen, whatever. That wasn't really what crossed my mind. But what happened is the cop pulled us over, and this guy had like a beat down. I wouldn't say beat down, but it was a Honda Accord. It was a Honda Accord, but nothing. Not there's anything wrong with the Honda Accord, but it's just like a very basic car. Anyways, the guy had a lot of money. When the police officer asked for the registration, he asked me to go pull it from the glove compartment. I pulled it out, and it said on there, I'm just pretending, it said FBO on there. It said trust something FBO on there. Didn't even have his name on it. And I was like, whatever. Passed to the cop. Cop looked at it, literally passed it to him. As soon as he got it, he read it, he passed it back to me. He said, have a nice day. And I didn't make that connection until years later that this kid was a trust fund baby. But he was really cool. He's like, cool, we're still good friends today. But this is like the whole concept is that when you're using these trusts, you can live essentially out of the trust. So this is the whole concept of own nothing, control everything. John D. Rockefeller. I'm sure most of you guys have heard of him before, right? But this goes beyond John Rockefeller. Okay, yes, he started, Standard Oil and Trust. He's, still today probably one of the most wealthiest people in the world in today's money standards. But the whole concept of this goes way beyond. A lot of people before him and after him understood this because this is all about contracts, right? We live in a sort of a country with contract. Everything is a contract. And going back to the financial aid formulas, right, and what's counted and what's not counted, if you really look at it, you'll understand that most of the assets that are not counted as assets are contracts, like a 401k or an IRA, right? 401ks and IRAs, most people don't realize those are essentially trusts, right? They're held for the benefit of, right, the person. So that's kind of how this stuff works. So the whole concept really is figuring out by using the trust estate, we're trying to keep things in your family's economy. We're not trying to put it over here with Uncle Sam. We're trying to keep things in your family economy as much as possible. We can only do that if we're operating through the trust estate. And the wealthy understand two things about money that most people never even think about. And this is really where a lot of these things take off when it comes to understanding how we're going to not only set these things up, but pay for college, right? So at the end of the day, we have to figure out, okay, if this is something that'll work for me or work for, my family members or friends or people I know, whatever. But you have to understand the concept that, wealthy people, they set these trusts up for a reason. They do these things for a reason. And the biggest reason is, number one, they understand that taxes make things expensive, right? If you have to work, earn money, pay taxes, and then pay for something like college, which is a huge lifestyle expense, it makes it a lot more expensive. And number two, every expense that you have has an opportunity cost. There's always a time value of money associated with everything. It doesn't matter if it's college, if it's buying a car, if it's whatever. So when we're looking at college, and this is how a lot of the people that I work with, this is how they understand this and they get this. They understand that, hey, if I have to pay for a school that's, 70 grand a year, if I'm in the 28% tax bracket, I got to earn $418,000 to pay taxes and then pay the college. And that's just for one kid, right? So we have to be doing things efficiently. So if we can fund college on a pre-tax basis, and we'll talk about that, that's a much more efficient way to do things. Number two is the opportunity costs. And I'm going to open this up, especially for Anthony, and I see there's a few other people that have gone through this process. I saw you typed in the chat box, but what could your business do with that money? If you didn't have to spend money on college, what kind of ROI could you get on that money? Ask some people to chime in. What do you think you could do in your business or your investments? Emily says, I could probably buy 3 more properties. Oh, for sure, I'm sure. Anybody else? What do you think? What if you didn't have to pay for college? What would that mean for you? How much could you make? That's something to think about. It's something to be very, very intentional about when it comes to this. So let me just go back here. All right. So 100%, 200% doesn't matter, but there's always a return on investment. Oh, Clyde says, I could probably make $1 million. Oh, good for you. Good. I need to know what you're doing. So you can't ignore opportunity costs or the time value of money when it comes to college. That's the key thing, the key concept you have to understand. When you're going through this process, every dollar that you pay for college, that's a dollar that you're not going to have in your retirement, in your investments, in whatever it is. So we have to be doing things much more efficiently. But when it comes to college, and this is what I see, I talk to a lot of people every day, business owners, investors, they're very savvy. They know a lot of stuff. They read Money Magazine. These are the strategies they use. They have a 529. That's great. 529s are great. And again, I'm not trying to poo-poo this, but you pay with after-tax dollars. So you had to work, earn money, pay taxes, and then put that money in a 529. And on top of that, guess what? It's part of your personal estate, so it's a financial aid asset. Roth IRAs, great strategy, right? But you're paying your kids money, right? You're paying your kids money. They're putting it into a Roth IRA. Obviously, that's after tax, not pre-tax, but great. It's going to come out tax-free later. But guess what? When you start taking that Roth IRA income out to pay for college, which you can do and not have to get killed with taxes, which is great. It's an educational expense. The colleges are going to look at that from an income standpoint. So it may not be taxable per se, even though there's some variances with that, but colleges are going to look at that. So it's going to bump your EFC up. Doesn't make any sense. Same thing with paying your kids. I see people do this all the time. And honestly, we used to recommend this a lot, especially with our college funding blueprints and stuff like that. But when you think about it, depending on where you're going and where your income is and all that stuff, that's going to make your financial aid income go up because, again, the students can make $7,600 this year. Anything over that, they get taxed at 50%. Because the colleges say, hey, if you're making money and you're a teenager, it has to be for college. It cannot be for anything else. So that hurts you. LLCs, you put your assets in an LLC, guess what? It's still part of your personal estate. Financial aid is going to look at it. Same thing for businesses. You don't get that small business exemption anymore. Living trust, same thing. It's part of your personal estate for financial aid purposes. And then life insurance is a big one. I love life insurance. But most people, the way they buy life insurance, they're doing it after tax. They work, earn money, pay taxes, and then they buy the life insurance. Well, do it through the trust. Do it through the trust. So it doesn't matter. You can do anything that you want. You can do oil and gas, Bitcoin, doesn't matter, stocks, real estate. Just understanding how to use a trust structure puts you in a much better position. So the problem is, and this kind of going, and we'll wrap up and go over some Q&A, is that if you're in the top 10% of income earners, right? And again, most people don't think they are, but you make more than 90% of the population. So you're going to pay more for college because the system, right? The government, the IRS, the FAFSA, the College Board, they think you that they identify you as wealthy, even if you don't think you are. So the system doesn't care about the risk you took or the amount of taxes that you paid to earn that income. They want your family, and that's the reality. They want your family to fund their endowments, their scholarships, and their other expenses. And that's I'm going to be going to this college, and this dean over there really likes this strategy, because at the end of the day, these colleges, they love charitable donations. And guess what? You can do that through the trust. So, but that's a problem with that most people have, is that the system thinks you're rich, you're going to pay more. And if you're not proactive, if you're not smart, you're going to be paying more than you need to. And it gets worse, because the more expensive the colleges are, the more kids you have to educate. And again, I have 3. I know some people, they got like 6 kids. But it doesn't matter. It's a huge expense. And obviously some of our kids are made for college. Some of them aren't, that it is what it is. But if you're going into this and you're like, yes, my kid's going to be a lawyer, they're going to be a doctor, whatever, we're going to go to college, we're going to have college expenses, you have to understand that time and taxes are not on your side. Okay. The longer you have to pay for college, the less time you have to recapture that opportunity cost. Again, it's about time value of money. And wealthy people understand this. This is how they make every single move. And I talk to people all the time. I got a guy right now. He's a developer in the local area. I explained this to him in about 3 minutes, and he got it. He's like this. I wouldn't say he's the smartest guy. He's pretty damn smart, but he got it right away, because wealthy people think like this, and they understand the higher tax bracket, especially when it comes to funding college, the more expensive it is. And this guy his daughter is super smart. She's like super cum laude valedictorian, like way smarter than I am. And she's definitely going to an Ivy League school. But, so he's looking at Duke, he's looking at Wake, he's looking at a lot of he likes schools in the South. He's a real Southern guy. Anyways, the higher tax bracket, the more expensive it is, because you're paying with after-tax dollars, right? And again, the whole goal is to try to do things as much as we can pre-tax. So if you can set up a properly structured trust that gives you asset protection, tax benefits, financial aid advantages, and that allows you to fund college on a pre-tax basis, that puts you in a much better position. Sorry, we got a question. Seems like the way to qualify for any financial aid, just about all the assets income has to run through the Dynasty Trust. Is that accurate? Yes and no. We'll talk about that. Good question, Dan. But yeah. So that's the whole thing. Again, this is what a family trust does. It allows you to do all these things. Protect your assets, get some great tax benefits, not have to have all your stuff on the radar screen of the Department of Education, and obviously pay for college pre-tax. So let's kind of get into how the family trust works. So our process, the way we do it, is we evaluate your situation, we strategize, and we can help you create a unique family trust, because everybody's situation is different. You all have different types of businesses and investments and how you do things. You have business partners, you're doing this, you're doing that. So that's something to kind of understand, and that's what we do. Now, again, I'm going to go back to what I said initially and say that trusts are not for everyone, okay? And I want to be very, very clear in explaining what I mean by that. Number one, this is only for people that obviously are property owners, business owners, or that investors, that taxes are a big issue for you, okay? I see a lot of people, I talk to a lot of people, I get a lot of recommendations, people that play golf, whatever, they recommend, and hey, I make a lot of money, Stefan, and I pay taxes, and it's just easier for me, and that's it. And that's fine. That's what makes the world go around. Again, that's how the colleges make money. They love people like that. But this has to be something from a perspective of, hey, I want to do everything I can to pay as little tax as I can legally. This has to be important, because why go through all this otherwise? And for some people, quite honestly, it's not that big of a deal. So if you want to not overpay for college or taxes, that's what a trust is going to help you to do. And obviously pay for college on a pre-tax basis. That's really what, obviously we're talking about with this call, it can help you out. But this is a long-term strategy. So if you're just, hey, I want something flash in the pan right away, whatever, like a microwave, this is something that you're going to use for the rest of your life and generations. And that's why, people set up these family dynasty trusts, the Kennedys, the Bushes, the Rockefellers. They all do this for a reason. It's not because they're looking at things just from an immediate standpoint. They're looking at things in the future as well. And they look at time value of money from a long-term perspective. So that's essentially who this is for. And obviously, if you want to grow your wealth tax efficiently, if if understanding the whole time value of money thing is important, then the time value of money on the tax bill is even more important, because every amount that you pay in taxes, that has an opportunity cost associated with it as well. Who is this not for? So if you have a only W-2 income, if your family that only has W-2 income now, what I mean by that is you work for a company, work for a corporation, whatever, that's all you're getting. If you're an S corp, or your partner's in a corporation, whatever, and you pay yourself a W-2 salary, we can control some of that. We can still use a trust. But if you just work for a company, you don't have any other business or investment income, this is not for you. Why? Because the whole point of the trust is to put assets and income generating assets inside of it and defer the taxes for decades. That's kind of how this whole thing works. So if you don't have that amount of that type of income, it's really not going to work for you. Now, that being said, I do have some people, they just have some vacation homes, this and that, and they're really looking at it more from an asset protection and privacy perspective, which is equally as important. Okay. But for the most part, this has to make sense financially, because there's a cost, obviously, to set up the trust and maintain it every year and do the bookkeeping and all that stuff. We'll get into that. But that's crucial. And obviously, if you're not motivated to pay less for college or taxes or do things differently, again, and there's no slight on anyone on this call. Speak to a lot of people that, hey, we make money, we're good, that's fine, that's it. So that's who this isn't for. So the benefit, obviously, when you're understanding and you know how to implement this and use it, is number one, you get asset protection, because again, you don't own anything in the trust. It's an irrevocable trust structure, right? Where you're just the sole trustee. Your kids can be beneficiaries, but they cannot. And I'll show you how that works in a little bit when it comes to paying for college, because that's obviously one of the things that we can accomplish when we're setting these structures up the right way. But this also gives you asset control, right? Because when you have control over how much taxes you're paying and how much, gosh, we live in a very litigious society. People can sue you at any, moment in time. How much control do you actually have over your assets? That's what the trust allows you to do. Obviously, tax benefits from a tax deferral standpoint, we'll talk about that in a little bit. Financial aid advantages, right? So understanding how these trusts work in comparison to other trusts, that's very valuable. And then allowing you to pay for college on a pre-tax basis. So these are the benefits of using a family or dynasty trust. So again, the family trust structure is, we're living out of the trust estate as much as possible to pay for expenses. Why? Because those expenses are not taxable. That's the whole thing. When we start doing things in our personal estate, right, you have to work, earn money, and then pay taxes to then pay for college. Using the trust estate works entirely differently. Now, the main thing you have to understand is you're not having to change a whole bunch of stuff. Okay. There are some changes you're going to make. Okay. But this is not like we're blowing the whole system up. So if you have LLCs, you have partnerships, you have things like that, you can still keep those things going, but we're going to implement the trust structure in here to start, making things a little bit more efficient. So the easiest way to understand this is that you're still going to have, a personal tax return, right? Bank account, balance sheet. This is the same thing. You do that, like you do now, but the trust estate is going to have its own entity. Okay. So it's going to have its own EIN, its own tax return, a 1041, bank account, bookkeeping, profit and loss statements, balance sheets. The only difference is obviously the earnings inside that trust estate. As long as we're doing things legally and we're setting it up the right way, and you're operating it the right way, it's tax deferred, and we can defer the taxes for generations. And then we can start doing really cool things. So from a logistical standpoint, all you have to understand, again, we'll go in the weeds. I'll start drawing stuff out. We can get into the jam session a little bit. But all you're doing is you're selling and transferring any assets that you have over to the trust first. So that's primary rule number one. We're going to transfer everything as much as we can. And I'll get to your question, Dan, into kind of how this works from a financial aid standpoint. But you can sell as much or as little as you want into your trust estate. But once those assets are inside, the assets are not taxable. The income is tax deferred, and now we can pay for expenses pre-tax. So when it comes to from a college perspective, right, this makes the utmost sense because now if I have rental properties, I can sell them into the trust. The trust can earn all that rental income, right? All the rental checks are going to go to the trust bank account, not your LLC or your personal bank account. I'm not going to pay any taxes on that, and now I can use that to pay for college, for tuition expenses, anything that's under publication 970 qualified educational expenses. That's a legitimate trust expense, and I don't have to take a taxable distribution. That's what makes this different. Same thing with K1s, capital gains. You flip real estate. Guess what? You don't need a 1031 exchange anymore. You don't have to worry about having to, find a property within a certain period of time and close and all that stuff. You can sell everything over to the trust, sell that property to the new buyer in the trust, keep that money in the trust, and use it for a lot of expenses, so what we're talking about right here is not only just college, right? But you can also buy real estate inside the trust. So we have a lot of people that will, especially in Chapel Hill, there's a lot of families when they realize we're in North Carolina, they think I'm a realtor. I'm like, no, I'm not in real estate. Like, oh yeah, I want to send my kids to Chapel Hill and this and that. We want to buy some properties, or they're really good. So we have a lot of people, it doesn't matter, Chapel Hill, any college town, what they like to do is they say, hey, I'm going to send my kid to the school. We're going to go buy real estate there. We're going to have our kid live there and become a landlord and collect some money and, offset some expenses. Do that through the trust. That's a much more efficient way to do things because number one, you're not going to pay tax on it. Number two, you're going to have asset protection. And God knows kids in college, you need asset protection, right? I don't think I'm the only one who is doing some foolish things in college, but that's that. And then on top of that, obviously not having to worry about, financial aid eligibility slipping from you or whatnot. But it's just a much more efficient way to do things. So you're doing it on a pre-tax basis versus after-tax basis. That's the main thing here. So the main thing, and this is what I want you, if there's anything you leave with this, and I want you to write this down and understand the concept of why this makes sense, is number one, the trust rules, the family trust rules is, again, own nothing but control everything, right? So you don't want to own nothing but not control it. And unfortunately, that does happen with trust sometimes, right? People will hire a successor trustee or another trustee, and maybe they're not responsible. That's sad. It happens. But with these trusts, you can have ultimate control. Okay, so you don't have to give that over to someone. Number two, if the trust owns it, the trust pays the bill. So when we talk about real estate, for example, with real estate, if I have my property in the trust, right? I want to just draw this out real quick because this is a concept that I think a lot of people miss when I go over how this stuff works. When I have a property, I'm just going to put on my iPad real quick. And make sure you can see that. Oops. So if I have a property inside my trust, right? The property is inside the trust. Okay. Guess what that property is gonna have most likely, right? It's gonna have expenses, right? A light bill, water bill, right? Property taxes, right? Need security system, all of that stuff. All those are expenses that people will typically pay out of pocket after tax. In the trust, I can pay for it with trust dollars. I can use trust dollars to pay for all those expenses. So when you really kind of understand how these concepts work, you understand rule number 3 of the trust rules, which is that any expenses that you have, you want to try as much as possible to pay those with pre-tax dollars. Never pay those expenses with after-tax money, because we're saving what? We're saving like 20, 30%, whatever your tax bracket is on every single bill. That's huge. From a college perspective, number 4, the trust can pay for all educational costs for beneficiaries under the age of 21. Okay, so all your kids, guess what? Instead of 529, use the trust 29 or whatever you want to call it, right? We can do all our investments. And by the way, 529s have horrible investment options for the most part. So trust gives you a lot more flexibility and things of that nature. So you can do all that stuff inside the trust and use it to pay for the same educational expenses. Oh, and by the way, that under age 21 thing is kind of misleading, because number 1, if you have a kid with special needs and they're over 21, you can have those special needs provisions pay for those special expenses. But also, hey, grad school. A lot of people, parents want to help pay for grad school. Guess what? We can use money from the trust. It may not be an educational expense, but we can get money from the trust, and I'll draw how that works, to pay for grad school on a tax favored basis. That's a much more efficient way to do things. And then obviously number 5, distributions are taxable to the trustee. Distributions are taxable, and the trustee, this is the key thing, going back to what I said before, is not required to pay credit or distribute income. So the whole reason of setting up the family trust is to never have to dissolve it, never have to take a distribution. If you want to take a distribution, you can. You will be taxed on it, but it's not required to. So from a financial aid standpoint, we're good. Number 1. Number 2, we don't have to worry about having to take money out to pay for expenses. We can do everything and expense things through the trust. Again, that's the whole concept of the family trust. So if you want to do things differently, pay less for college, protect your assets, reduce your tax bill, and then pay for college on a pre-tax basis, if that's important for you, then you definitely want to take a look and see, hey, is this something that's going to work for me? Is it going to work for my family? Is it going to work with all the different investments that we have going on? We want to fill that out for you and put you in the right direction. So all you have to do is set up a trust evaluation call. You can scan the QR code that you see here, or you can text the word college to the number that you see on the screen, 919-420-3798. I will put that in the chat. But all you have to do is do that. It's no cost, 15 minutes. You get to ask any questions that you have. You can kind of air your dirty laundry in front of us instead of in a Zoom call with a whole bunch of people, and really figure out if this is going to work. And we're pretty good at letting people know right off the bat, unless you have extenuating circumstances, we can let you know, hey, this is how much it's going to be, this is how it's going to work, and this is going to work for you, or it's not. At the end of the day, like I said, this is not for everyone. So I'm all about being very transparent and letting you know very quickly if this works or not, because at the end of the day, results are the only thing that matters to us, and it should be the only thing that matters to you. So that's kind of our approach when it comes to this. So you can go ahead and book your evaluation call. Now, I will tell you, especially this time of year, the word is kind of out. A lot of parents know about the whole prior year and everything. Some parents don't. So we get busy right around the time when students are getting their award letters and stuff like that. And probably why you hear emails and stuff like that. But anyways, long story short is I'm telling you, just being very upfront and transparent, that we do give priority to urgent cases. And the reason why is because we have people all the time that are like, okay, yes, my kid's going into their junior year. We got, a property. I got a guy now, he's selling a $3 million property in Charlotte, and he wants to use that. His mom's got some health issues. He wants to use that to pay. And then obviously college, but guess what? It's going to kill him from an EFC standpoint. So we have to, we give priority to those people because he's like closing in 30 days. So, and I'll go into the sequence of this. So just kind of understand that if this is your situation or someone that you know of situation, they need to get on the ball right away, because it does take time to set things up. So the timeline to kind of understand how this actually works from an implementation standpoint is we do have an onboarding process. It's usually about 1 to 3 sessions. Obviously, after the evaluation call, after we find out, hey, this is going to work for you or it's not going to work for you, we do have an onboarding. It's usually maybe 1 to 3 sessions. Some people learn quicker than others. And this is not, there's no judgment. Different people have different learning styles and stuff. And we can get your CPA on and your tax attorney on and all that stuff with our back office and field everything out. But once that happens, we'll complete the intake form and payment to go ahead and start the setting up the trust. Then we got to order the EIN. That takes about a week. Okay, so every trust book, you get a trust book. So just so you know, I have a trust. This is my trust book. Okay, this is what you get. It's called a governing instrument. Every trust book is put together. It's customized, mapped out how you run things. If you have LLCs, how many properties you do things, all that stuff. So it does take time to set up that trust and then to deliver the trust book. Then we have to notarize the trust book and activate it, get the trust actually activated. That takes about an hour. And then open the bank account, because again, you have to have separate EIN, bank accounts, tax returns, books, all that stuff. Trust bank account takes, it says 1 to 3 hours. I would say just plan on a day. It might be an all day, depending on the bank. Then we introduce you to our bookkeeper and CPA firm. Then we have to start selling assets over there. So that the depending on how much assets that you're actually selling over, it could, and it says 1 to 3 hours. I have people that have a guy now, he's got about 20, well, what do you call them? Section 8 homes. So it's taking him a while. So it could take some time, and then obviously the rest of your life. But the point I'm trying to make is I want to set some realistic expectations as far as how this actually works. If you want to start moving forward, is this stuff has to happen right away. Like there's not a lot of time. There's time that it takes to set it up. And again, people that are closing in the next 30 days or week or whatever, they reach out to us. That's kind of how it is. So just understand that, and understand also that the trust is not a time machine. Okay. If you have already earned income in 2024 up until May 9th, there's nothing we can do about that. Any income that you've received, that you have constructively received into your personal bank account or into your LLC or whatnot, we cannot defer that. We cannot put that in the trust. Okay. So the way this works is your trust has to be set up before that taxable event, before you've taken income from that LLC or from your investments or from that capital gain. So you have to have this stuff set up before this happens, not after. And then obviously, again, the timelines. You have a kid that's a junior, that's going into their junior year in high school, you need to get on the horn right away. So just kind of understand all of those dynamics, and our calendar does fill up really quick. So just really, really understand that. So our team, again, we have all the forensic CPAs, enrolled agents, tax attorneys, bookkeepers. This is what they've done for years, over 40 years of experience. A lot of our people have worked for PricewaterhouseCoopers, BDO, ex-IRS agents, law professors, so they know what the heck they're doing. And we understand how this stuff works and how it has to work with everything else that you're doing from a legal standpoint, from a tax standpoint, and from a standpoint of documentation. Everything is all about documentation and making sure everything's reported and done right. And so that's where a bulk of where their time is spent, is making sure that's done. And then obviously making sure that, God forbid, if you get audited, that you're protected. So it doesn't make sense to do all of this stuff and have to risk anything. Risk it for the biscuit, as they say. So these are just some case studies. These are not the actual people here. Obviously, people that have trust want to keep things confidential. Some of my clients have given us permission to share tax returns, which are redacted, which I'll go over. But this is a guy purchased property for about $400,000. This guy was in South Carolina, I believe. South Carolina or Georgia, I can't remember. Purchased about $400,000 25 years ago. Property is worth about 3.5. We did this transaction last year. He avoided about 1.1 million. He took a lot of depreciation. He was considering to do a 1031 exchange, didn't. He's happy about this, and he used some of those funds to cover the cost at Pepperdine, which if you haven't seen Pepperdine, it's a beautiful school in California, but it's hell expensive. This is a dental practice, dental owner. It's a solo practice owner. So this guy's was Schedule C. So just did everything, straight to his name. Made about 700K a year, paying over 200 grand in tax. We deferred, it ended up being about 65% into this trust structure just because of how his entity was set up and how he had to keep his licenses set up in the state of, I think he was in Texas. K1. Okay, K1 investment. We have a lot of people that invest in real estate, especially now this time of year, the US Open. I have a lot of people that have bought real estate here, and they're renting it out to these golfers and making ridiculous amounts of money. But K1 investing, K1 income, if you're a partner in any type of investment group or private equity or whatever, these trust structures can really, really work, because this guy invested about 300 in this LLC. Obviously, you're going to pay tax from that K1, but what we did is we were able to change that K1 from an active K1 to a passive K1 through the family trust. Okay, and saved about up to 90. You can do about up to 90%. This guy, and we'll talk about trust expenses and all that stuff. He did a lot less because he had some other things that he needed to do. But you can do up to 90%, which is really cool. And then rental income. Okay, and this is a really cool strategy. This is like one of the coolest ones from last year. The guy sent us about he wants to come here and do an event, and probably is not going to happen. But anyways, he's got a whole bunch of multifamily units. So if you're in real estate, people in real estate, this is a great strategy for them. Made about 400K a year. Obviously, did all the cost segregation and this and that, but after all that was soaked up, you got to pay the piper. So he's making about 400 net a year from the rental properties. We sold everything to the trust. Okay, trust absorbed all that rental income. Doesn't need depreciation anymore. Doesn't need to go buy another property and get a loan and do this and do that. And they qualified for $67,000 in grants from Lehigh University. This is the award letter that we got last year. So this was really, really cool. This is one of our coolest success stories. And this lady, her daughter, I don't have the award letter, but she ended up going to University of Miami. This is their 2020 tax return. So it's about $500,000 that they made. Amanda didn't change this, but you can see on the side on line 24 on the very left side, this is their tax liability, about $174,000. So that was 2020, and they ended up coming us to late 2021. There's not a whole lot we can do, but for 2022, this was their income, $56,000 net taxable. Right? So they got a lot of money from the University of Miami, and they saved a bunch of money in taxes, right? Going from 175 to 5, that's a huge, and they were really, really happy. So these are the type of things that can happen, but again, you have to be proactive when it comes to these structures. So again, this is our process. We evaluate your situation, we strategize, again, figure out how we're going to do this for your particular situation and map it out, and then help you create this trust. It's just that simple. Again, this is the timeline. Again, understand things have to happen. If you're closing on a property tomorrow, probably can't help you, okay? But if you're closing on a property in the next 30 days, we need to get on the phone. We need to get a call going and get things happening. So, so that's pretty much it. Thanks for hanging on the call. We made it in about record time, hour and 26 minutes. So if you want to go ahead and schedule your call, go ahead, again, scan the QR code that you see there, or just text the number college to the number on the screen, and I will go ahead and put that in the chat as well. And that's it. So I will open it up for questions. I'm going to unmute everybody, and I'll go through some Q&A, and you can just open your mouth. Obviously, Only one person at a time can talk, and we'll take it from there. All right. If you have any questions, go ahead and just unmute and ask away or put in the Q&A. Okay, let's see here. Look at this first one. Amelia. Okay. Does my living trust need to be amended? No, living trust. So the easiest way for me to understand this, if you have a living trust, you can keep your living trust. Okay. You don't have to throw it away. However, if you want to put things in the family trust, you will, number one, have to establish a new trust. Number two, you can take those assets, revoke them. So let me just draw this out real quick. You can revoke those assets into the family trust. That's kind of how it will work. But unfortunately, it's because these things are creatures of contract and they have to be set up a certain way and have certain provisions. There's no way to amend your living trust, because 9 times out of 10, I guarantee it's probably a statutory trust, which again defeats the whole purpose of how these trusts are set up. These are pure contract trusts. So let me go ahead and draw that out to just explain to you how it works. And I get that all the time, so don't feel any type of way. But unfortunately, that's how it has to work. Let me see if this thing is going to come up. Okay, all right. So so remember, the trust, your living trust, is part of your personal estate. Okay, your PE. It's still part of your PE. Okay, and it's probably because you set it up as a grantor or something like that. But it's still part of your personal estate. So you can have your house in that trust. And here's the thing to understand too, is you have options. Okay. And I'll get because this kind of dovetails into Dan's question as well. But you can revoke that living. I should actually put this here. So this is a living trust, because it is, yes, a separate trust estate, but for tax purposes, it's not. So you would have to revoke it back into your personal. Let me just clear everything out. So this is your living trust. This is your personal estate. Your house is here. Okay. You're going to have to revoke that back into your personal estate. Okay. And then you can sell it over. I'm just going to put FT, family trust. Then you're going to sell it over, right? Because when we use these trusts, we're doing an actual notarized bill of sale. We're not gifting everything over. Okay. So it's much different than how you do things with your living trust. But you're going to sell it over to your family trust. Okay. And you're going to do that at cost. Okay. And what I mean by that is we have to look at the cost basis, what you paid for the property, plus any improvements that you made. If you took depreciation, is it a primary residence? The primary? Yes. Okay. It's a primary. So if it's a primary residence, we can actually use the exemptions, which is really cool. That section 121 exemption, that 250 or 500. So we can just calculate that cost basis or book value, sell it over to the trust, and we're not creating a gain. So if that amount, let's say you bought your house for 200, right? And it's worth $1 million, let's just say, but you bought it for 200. We're going to use your $500,000 exemption. You didn't take any depreciation. We're going to sell it to the trust for 700,000. Okay. So that's what happens when we sell it over to the trust, but we're not doing it at a gain. So there's no capital gain that's going to be triggered. Number one, because it's after tax dollars, right? That you use to purchase that home. But number two, where there's no constructive receipt. So the property is going to get transferred over to the trust, right? It's going to be in the trust, and then the trust owes you 700,000, right? And that's what you can use. This is what we call a demand note. So let me just clear this out. This is what we call a demand note or a note payable. Okay. So let's just do family trust, personal estate. So when we sell assets over, right? When we sell, we do a bill of sale, a deed, right? We're doing a legal contract for the assets over. We're doing it at cost, 700K. And now the trust owes you 700K. Okay. That's a note payable. So you can take that money out of the trust. It's not taxable. Okay. There is an applicable federal rate. There's an interest rate we have to associate to that because you can't give, interest-free loans. But that money you can use for whatever you want. Food, fun, and fashion, what we call, hey, expenses that are not typical trust expenses. You want to go buy Jordans, go to, take a vacation, things like that, or pay for grad school, right, for your kids. That's how you could utilize that. Okay. But everything that's transferred over into the trust is done through an actual contract, through an actual sale. So Dan's question, something is, it seems, so I want to answer the first question about financial aid. So the first thing to kind of understand is, yes. So what we're trying to do is get things off the radar screen of the Department of Education for financial aid purposes, if it makes sense. They're looking at an expensive private school and you don't want to pay 60, 70, 80, $90,000 a year, then obviously you'd want to do as much as you can. But if it's not a financial aid issue, then we're not even going to touch it. We're looking at this more from a tax savings perspective and paying for college pre-tax. But hey, you may say, I don't want to put all this in the trust. That's fine. What other assets can we do where it's not counted for financial aid, right? So that's essentially what we're looking. But you don't have to put everything into the trust just to get financial aid. I think that would be stupid, and you don't want to make decisions just for one thing. They say the tail wag the dog or whatever the heck. So you want to make prudent decisions, but yeah, you don't have to do everything. We can look at different things, but do as much as you can if it makes sense. And the second question is, seems you have to take distributions from time to time to pay for food, fun, and fashion. Yes, if you want to take a distribution. So the thing is, so I went over the demand note, okay, and hopefully you understand the demand note now, because it's just an IOU that the trust owes you. But if you need money outside of the trust, yes. So any distributions obviously are taxable. That's any trust, okay? Family trust, charitable trust, doesn't matter. So obviously distributions are taxable, but there are other ways. For example, you could pay yourself a salary, okay? Because as a trustee, guess what? Your job is to manage and take care of and grow the trust. So you can pay yourself a salary, a reasonable salary. There's calculations for that. Attorneys will walk you through that, but you can pay yourself a salary, obviously to your personal estate. You're going to pay taxes on that, right? In your personal estate. But it's an expense to the trust. Okay, it's not a distribution. Okay, so the trust will just report that on its books. So there's different ways, and we can kind of feel that out as we figure out how we're going to set up your trust. And I'm glad that you asked that question, because these are things that people are thinking about, right? When you're obviously you want to do things efficiently, pay for college as tax efficiently as you can, but hey, I got to eat, we got groceries, we got to, we want to go on vacation, whatever, there's things that you're going to want to do and that are not necessarily trust expenses. And we want to be able to do those legitimately. So if you want to take a distribution, if you have to, you can. The good news is that with these trusts, the distributions that you take are taxable only on the earnings for that year. Okay. So these trusts can use the simple codes, but they also mainly use the tax code, what are called dual track trusts. I want to get too into the weeds of that, but yeah. Okay, Nancy says, what is the average cost to set up a trust? How do you add money to the trust without tax implications? All right, so the cost of the trust, here's what I would say, Nancy, and you can open up if you have specific questions you want to talk over, you can say it right now or whatnot. But the cost of the trust is really going to vary depending on, number one, what type of assets you're putting in, how many assets that you have, do you have LLCs? All of these different things are going to determine what the cost is going to be. Hey, do you need audit protection? All these different things. We're here to customize the trust and make sure, obviously, that it works. But at the end of the day, it has to make sense financially. Obviously, it has to work. You have to like it, but it has to make sense. If it doesn't make sense, then obviously don't do it. And everybody, the reason wealthy people do this is because it makes sense from a tax perspective. So I think that's the main thing, is figuring out, okay, from a tax perspective, what does it make? Where's that breaking point where it makes sense or what doesn't? I can tell you this, that if you're thinking about spending like $5,000, $6,000 for a trust, this is not for you, because those types of trusts, when you go to attorneys that set up these aren't cheap trusts. Okay. But when you look at, okay, how much capital gains, so for example, the guy that's selling that property for $3 million, the capital gain, I think, was, I want to say no, it's more than that. I want to say maybe 500. I can't remember exactly. I have to go look at stuff on my computer, which I'm not going to do now. But I think his trust was maybe like 75 grand. It made all the sense in the world because he was looking at a huge tax bill. But because of how his assets were set up and businesses and all this stuff, so it's not there's a moving needle. But again, the main thing is figuring out how much tax that you're looking at, and what kind of income do you have? Is it business income? Is it rental properties? Is it K1s from investing, all that stuff? So that's, hopefully that kind of answers your question. But again, we can feel all of that over the 15-minute evaluation. I can tell you within 15 minutes, probably less, hey, this is how much it's going to cost, and this is what's going to make, if it's going to make sense or whatnot. As far as adding money to the trust, again, you don't add the way that, and I want to make sure that everyone's aware of this, how this works from an income standpoint, because this is really the value of these types of trust, is understanding that, hey, it doesn't really matter what kind of income that I have, as long as it's not W-2 income, right? Because again, if you're W-2 only, not a whole lot you can do. Excuse me. That money's hitting your personal bank account and that's it. But if it's rental property, for example, so let me just clear this. If it's rental property, right, you're just going to sell that rental property over into the trust, okay? Property goes from your personal estate or from that LLC, right? Because a lot of people at real estate do LLCs, but LLCs means large lawsuit coming. You don't get a whole bunch of asset protection with LLCs. So sell it over to the LLC, and then all that rental income, that rent, as long as it stays inside the corpus of the trust, it's tax deferred. Okay. So that's the main thing to kind of understand, is that everything is staying inside the corpus of the trust, but you have to sell the asset over first. So it doesn't matter if it's real estate or if it's stock, you have a stock investment, Bitcoin, whatever, you're going to sell it over to the trust first. Now, if you have income from a business, from an active business, okay, and I'll explain how this works, because maybe that's what you're alluding to, or you can correct me if I'm wrong. But if you have an active business like an LLC, right, that's active income. Maybe you're running it through an S Corp or a C Corp or whatever. That active income, you're not putting it inside the trust. A lot of people think, hey, I'm going to get an LLC and I'll put the LLC inside the trust. The trust does not own any active businesses. It doesn't own anything. So you can keep operating your LLC the way you want to and earn that income. But all we're going to do is take money from that LLC, in the case of that example that I showed you, and we're going to shift it into the trust. And there's a few different ways to do that, but the main way to do that is through an LLC partnership. So you would set this up as an LLC partnership. So if it's a single member disregarded, you would have to just change the election or set up another LLC, whatever. But that's would be the easiest way to do that. And from that part, the LLC, you would be the general partner or the managing partner. And then the trust, right? Your family trust would be the beneficial, I'm sorry, would be beneficial trust, family trust, sorry, would be the limited partner. Okay. And we can take up to 90%, up to 90% of that net income into the trust. Okay. But we're doing that through a passive LLC. We're not doing it through an active LLC membership. So that's how you get money from businesses or investments or things into the trust. If you have cash, just like cash sitting there, then yeah, you can put cash into the trust, but you're still going to do a bill of sale. Okay. So hopefully that answers your questions. You can unmute if you want to. I don't know if that answered your question.
So Stefan, I'm not sure if you hear me,
Yes, I can hear you.
but do I need to put money in the trust periodically every month to fund it?
No,
If my living expenses are coming out of the trust.
So good. So if you're living expenses, and here's the thing to kind of understand. When I say living expenses, I'm really meaning trust asset expenses. Okay. So again, when we're talking about let me just go back here.
Utilities, insurance.
Yes, utilities, insurance, the mortgage, the property taxes. Those are trust assets because the property is owned by the trust. It's no longer a personal expense. It's a trust expense. Again, if the trust owns it, the trust pays the bill. So you want to have income coming into the trust. So you definitely don't want to have a situation like this where you just have assets inside a trust. You can definitely do that. But if there's no income coming in, either from rental properties or from dividends, a lot of people do stock investments, royalties. We have a lot of people that do oil and gas, interest payments, do promissory notes, any type of passive income. That's the key thing here. You want to, or again, in the case of the LLC, the passive K1s, you want that to come in to pay for those expenses. And obviously there's a cost of, maintaining the trust. You're going to have to do a tax return every year. You're going to have to do bookkeeping. So it's no different than, a typical entity that you would set up, but you're not paying taxes. So that's really the value of doing things. But you can sweep income. So if you're talking about income from your business or from your if you're self-employed or whatnot, you can put in, you can do that monthly, do that quarterly, do that yearly. It's bookkeeping. But if you want to use the money to pay for those expenses, then yes, it obviously has to hit the trust bank account to pay for those expenses.
So that only works if there is a passive income. If it's a sole proprietorship, it's not recommended.
No, you can do it with the sole proprietor. So check this out. I'm glad you asked that. And I apologize for not being clear enough. So the 1099, so 1099 itself is active, right? It's just like W-2, right? Except there's no withholdings. So 1099 is active. So 1099 itself, I'm just going to put family trust here. 1099 itself is really no different than W-2. We can't put that into the trust because it's paid to you directly, right?
Mm-hmm.
It's paid to you directly first, and then obviously you're paying taxes and self-employment taxes on top of that, which is even more.
Yeah. Yeah.
So 1099 itself cannot go into the trust. So there's a few things we can do. You can, if you want, set up an LLC, obviously depending on if you can, if your company allows it and the regulations of the industry that you're in allow it. You can set up an LLC, have your 1099 income go to the LLC, and just do it as an LLC partnership. That's one way to do it. Okay. So LLC partnership. The other way is from that 1099 income, you can, because pretty much everybody that I know that's 1099, realtor, insurance agent, medical, pharmaceutical rep, whatever, if you're self-employed, part of what you do is you have what we call intellectual property, right? You may have a website. You may have a client list, right? These are what the tax world they call intangibles, so to speak. A client list. You may have some sort of process. You may have a logo, an email, something that makes what you do part of your income. Does that make sense?
Yes.
So what you can do is you can take that IP, because that IP is part of your personal estate, okay? That's still PE. You can take that IP and you can sell it over to the trust, okay? And sell your intellectual property, and then you can lease it through the trust. So now we're creating a lease expense from your 1099 to the trust, okay? And that income's going in there. Now, that being said, how much can you do? There's an evaluation. It's definitely not up to 90%, maybe 50, maybe 70, depending on how the CPAs and attorneys and all that stuff can put it together and document it. But we can, shift some income in there. Okay. So that's how you would do it. So then there's lots of other ways, even as a sole proprietor, but we're trying to take income that's passive or create passive income in this standpoint and shift it into the family trust. But obviously you still need what, right? You still need money to buy groceries, right? To go on vacation, to all of these things. So there's a figure of, a process of figuring out what that number is for it to work, if that makes sense.
Yes, thank you.
So hopefully that answers your question. Let me see what other questions I have here. Olga.
Yes.
You
Hi.
can unmute. Hey, Olga, how you doing?
All right. So, Stefan,
Yeah.
I recall that in a trust, the highest tax bracket kicks in at a very low threshold,
Yeah.
right? So, doesn't it lead us to the need to balance out the inflow taxable income and
No,
the outflows distributions that get carried out as a deduction to the trust, and we need to get to that leftover that's close to zero to avoid the higher tax rate, or you do two parallel computations to balance out what works best at the personal level as opposed to be placed in the trust.
100%. You hit the nail on the head, because we don't remember these trusts are what are called, and again, this is, we could literally be here for hours, and I appreciate you guys staying for this long.
Right.
But this trust has, as a trustee, the trustee has discretion, right? There's a discretionary provision to not distribute.
Exactly.
Right. So we don't want to take distributions. That's the entire point of doing this, because you're absolutely right. Once you hit what, 14,000, I think, and this is the standard exemption this year or something like that, then it's taxed at the highest rate, which is like 37%. So you don't want to take distributions, but you do want to expense. And so that's the whole point of figuring out how much do I actually put in this trust for all the things like my real estate, right? I have my primary residence, my car, right? You can go and pay money out of your personal bucket to pay for the car and pay for the gas and pay for the insurance, right? Or you can have the trust own the car and pay for all of that stuff pre-tax, right? So it's just figuring out what's going to work for each individual. But when you understand, I'm sorry?
So you kind of a reverse engineer. So you look at the expense side on personal or maybe business assets and see how much you can stuff it into the trust, and that's your deduction. And then you need to somehow fabricate, or not fabricate, it's not a good word, generate sort of an equivalent amount of income taxable to the trust, so you can zero out the taxable income.
Yeah, so I mean, and it's not necessarily zeroing out taxable income, because remember, the trust doesn't pay any taxes.
Well, it doesn't it?
No, it doesn't. The trust doesn't pay any taxes. Remember, this is tax deferred.
Well, I thought the taxable income remaining in the trust is taxable unless you
No.
carried it out, and then when you carry it out to the beneficiary, it's taxable. The distribution.
If they take a distribution, but the beneficiaries, remember, the discretionary provision of this trust allows the trustee to declare. So the trustee makes a declaration every year. I'm not
Yeah.
going to pay, credit, or distribute to any beneficiaries. So they make that declaration. It's tied right to the 1041, and there's no tax. There's
To
no
the
tax.
beneficiary.
There's
To
no
the
tax at
beneficiary.
all to the beneficiary
all?
or the trust. No.
Oh,
Yeah.
okay.
That's why. Yeah, that's why this works. That's why.
mhm.
So we're keeping everything in the corpus of the trust. We're keeping
Oh.
everything in the corpus of the trust. That's why this works. If it's outside of the corpus, that's different. But we're keeping it inside the corpus of the trust.
Yeah, but in response to the previous question, when you explained the structure where you have a partnership between the trust and the solo owner of the business,
Mhm.
let's say it's LLC or pass-through business, operating
Mhm.
business, it gives a K1 paper income to the trust, even though the trust might not get the distribution or cash or not the equivalent amount of cash. So you
Exactly.
still have the paper income in the trust.
Exactly. Yeah. So the income's in the trust. It's not in the LLC anymore, right? So now there's less
Right.
income in this LLC that's taxed.
Oh, you see, I see what you're saying. Okay.
Yeah.
Okay. All right.
But
Thanks.
yeah, no problem. Let me see other questions I have. So is paying for grad school a taxable event? Yes, if you take a distribution, then you will pay tax. Okay, that's no different. Though the grad school strategy, again, just to kind of clarify that, we're not go family trust again. We're not taking a we're not expensing grad school because obviously at that time the person's going to be over 21. So it's not an expense. Okay, not an expense. What we're able to do is we can take money from our demand note, right? Because that's on demand for whatever you want. And you can take that out and use it for whatever you want. Okay. So that's or there's different ways you can get loans from the trust. You can loan against the trust. Again, that's what makes this different than your typical like charitable remainder trust or stuff like that that don't have debt. This trust is allowed to have debt. Take that on. Okay. But obviously there has to be collateral. So you're just finding creative ways to take money outside of taking a taxable distribution to pay for whatever it is. So if it's grad school, if it's going to, Paris, whatever. What if you want to sell the rental property in the trust? Yeah. So when you sell that property, so this is what's known, we do this a lot as a double closing, when it's like down to the wire. So if you have the rental property over here in your personal estate, right? And you've taken depreciation and all that stuff, cost segregation, everything, right? There's still going to be a book value, hopefully, that we can, that's going to make sense. But either way, we're going to sell this at cost. So we're going to look at the cost basis, depreciation, any, improvements, and we're going to calculate that book value. So let's just say that number is 500,000, even though that property may be worth 2 million. Okay, we see that all the time. We're going to sell that at cost. So we're not creating a gain when we sell the property over to the trust. Trust here. So once that happens, the property goes over, changes hands to the trust. Trust owns it. And literally within moments, and we do this a lot, it's called a double closing if you're not already familiar with that. We sell that property to the new buyer. Okay. And then all the proceeds go back into the corpus of the trust, and there's no capital gain. So no gain because we're keeping this inside the corpus of the trust. So it doesn't matter if it's rental property or if it's, primary residence, it's the same sort of thing. Okay. You had a question? Olga? I think your hand's raised. I don't know if it's on
Oh,
that.
maybe by accident.
Okay, it's all good.
But anyway,
Um,
so it's like a deferred sales trust, in other words.
better
So
than a
better?
deferred sales trust, because
Okay.
deferred sales trust is, first of all, the deferred sales trust, you're the note holder. You're not really the owner of that
Oh,
asset. Yeah, the deferred
I
sales
see.
trust, yeah. And that can work for some people too. We go over that. Again, we're talking about the family trust for this particular session. But
Mhm.
deferred sales trust is you actually would sell it to the trust. The trust would give you a note payable, but that trust, there's a separate trustee. So the difference between this and
Oh,
the
yeah.
deferred sales trust is you're not the trustee. Okay. Deferred
Mm-hmm.
trust, you're not the trustee
Right.
or the beneficiary. You're just a
Mm-hmm.
note holder. So the
Okay,
trust
so
basically owes you a note.
right. But in this case, the trust realizes all the cash
Yep.
from the sale to the unrelated party, and then you keep the proceeds, and then let's say you reinvest them, or just to simplify, let's say you just reinvest them into interest-bearing account like T-bills or whatever.
Yeah.
So let's say you're earning your 5%, and so then that's taxable income to the trust. But earlier you said to me that the trust doesn't pay
Yeah.
tax.
So it doesn't. So I think there's just, and it could be honestly just kind of an understanding. So there's a taxable event. Okay. That's the best way to
Mm-hmm.
understand it. So there's a taxable event. That's all that's done within, the tax records and the books. So you can't avoid the taxable event, right? That's
Yeah.
happened, right? Once you
Mm-hmm.
sell something or you earn income, that's a taxable event. So the taxable event, yes.
Yes.
Okay. Actual tax bill, the tax is deferred, and it's deferred for generations. So the easiest way to think of this is a 1031 exchange on steroids.
Mm. Okay.
So
That's
there's
the
a
first
tax
time I'm
bill
hearing.
due that's going to sit there and keep growing until someone one day distributes it, which will probably be the December 32nd of number. That's that's how the wealthy people use these things. But yes,
So,
in actuality they could, but yes, they're going to pay a huge tax at that
but
point.
is this the feature drafted in the trust instrument? The
Yes.
deferral.
Yes.
Oh.
All
Oh,
of this,
okay.
yeah, because it's a contract. So again, and that's the key thing to understand when you're looking at your typical living trust or grantor trust, these are statutory trusts. This is an actual contract, a private contract. It's not a
Mm.
creature of legislature. And again, that's why wealthy people use these types of trusts, because you can have those provisions in there.
Okay.
So
I got you.
the beneficiaries essentially, once the trustee pass away, the beneficiaries, they can say, hey, we'll terminate the trust and obviously
Mm.
pay the tax, or they can become the new trustees.
Okay.
That's what
So,
happened.
before we end this call, will you please show your phone number again?
Yes, let me go ahead and thanks for reminding me, because I'm kind of absent-minded. So let me go ahead and put that in the chat real quick. So just text the word college to 919-420-3798. And then they'll just take you to the link, and you'll either be on a call with me or Andy or Michelle.
okay, can you repeat the number? Since I don't know, my chat is disabled for some reason. I
Okay.
can't.
That,
420.
yeah,
What's
let me do you one better. Here, I'll just put it back on the screen.
okay?
It's
Gotcha.
okay.
Thank you. Mm-hmm.
Dan, you can speak. Or was that an accident? All right. Any other questions? Thanks, guys, for hanging on for so long. Yeah, Dan, you had a question?
Yeah, I wrote it in the chat.
Okay.
I thought what Olga was getting to was important, and I don't know that it was, or I didn't understand the answer if it was. Um, I think Olga was indicating that we need distributions for the fun, food, and fashion, and anything above 14 grand gets taxed at a very high rate. I think it's 39% or
Yep.
somewhere around there. So in that case, since most of the people on this call are we've got money and our fun, food, and fashion is sizable. Um, wouldn't it and wouldn't it make sense to keep some income generation outside the trust along with deductions that apply to us and certain things,
A
and
hundred.
so that our effective tax rate for that is less than 39%?
Yeah, so I think the thing to kind of understand is this is a personal decision. You can put as much or as little as you want. Me personally, so this house that I'm in right now, that's in the trust. Our two BMWs, that's in the trust. I have a real estate property that my mom uh, is basically going to give to me. Could I put that in the trust? Absolutely. We've made a decision not to for reasons that I'm not going to go over on this call. But the point is, it's a personal decision. You put as much or as little as you want. The whole point is, once you put it in the trust, you can't take it out, right? That's like the main thing to kind of understand. It's irrevocable, right? You can't revoke it back into your personal estate. So that's number one. Number two is understanding, yeah, okay, we need money for food, fun, and fashion. Keep stuff in your personal, and you're going to need money in your personal bucket. You're going to need money. So we don't ever say, hey, live, 100%. I mean, there's really no way to do that, but there's some people that come pretty close to it. So I think that's it's a personal decision. It's something that you have to kind of fill out, and our back office will do that with you when they're setting up the trust for you. And things change, right? Life happens. Things aren't the same as they are today as they will be, tomorrow. So if those things change, you can always make those modifications. But yeah, you definitely want to have some money outside of the trust for things that you need. But again, it depends on your demand node, because I do have people, and um, this is the gentleman I actually am going to be talking to tomorrow, that are just they're retired, for example, okay, and they you know, they don't have any kids, or they do have kids. They just don't really care about them much anymore because they're old and grown and do whatever they want. And their whole feeling is, hey, I have all this stuff. I want to enjoy this while I'm alive. I don't know how long I'm going to have to live. And so what they do is they will sell everything, because obviously, this guy in particular, he's got a whole bunch of real estate, whole bunch of properties in here, and it's about 8 million. So he's got all this stuff in his personal estate. He did take some depreciation, but some he didn't. So I think when it's all said and done, it's about $8 million worth of real estate. So that's the worth the real estate. But his demand note is going to be about 4. Okay, because that's his basis and all that stuff. So his um his perspective was, I want to sell all this stuff and sell all the properties in the trust, obviously, not have the capital gain. I'll have the $8 million in here. Okay. And for me, it's just him. He lost his wife. He said, I think I can live off 4 million. He does want to do some cool stuff and, buy boats or whatever. But he's like, I think I can live off 4 million for the rest of my life. Okay. And so that was his decision. So, I mean, everybody's gonna have a different thing. But if he needs money for food and fashion, he's got a pretty big demand note, and I'm pretty sure he's not going to need or use all of that, because he's selling all his property, and the one property he has that he's living in is in the trust, and that's paid for with trust dollars, and he's doing some oil and gas and life insurance and all that stuff. So yeah, you definitely want to keep money, you know, outside of your personal, outside of the trust estate for obviously personal things. but that's going to be an individual decision. Some people are going to be more aggressive than others depending on their situation.
Okay.
So good question.
If I could just ask a question about this particular example. So he put this money in, or he put these properties in the Dynasty Trust, Family Trust.
Yep.
And you've indicated that he says he could live off the 4 million. Is that 4 million fun, food, and fashion? Is that what that means?
Yeah.
Okay.
That's a pretty big demand.
All right. And
for him.
with that, he can take loans against that, so he's not really paying tax on that because
That's correct.
going to be, yes, okay.
He's
And
okay.
then I guess whatever income that real estate is generating goes towards his expenses, his house, his boat, his car, whatever.
Is buying all that stuff in the trust.
Right. Okay.
Oh,
All right.
yeah.
So he would be fun, food, and fashion for the rest of his life is 4 million taken away, not really taxable because he's creating loans against it. Is that accurate?
Yep. Yeah,
Okay.
he's borrowing it. It's note payable, so it's just interest. So from a theoretical standpoint, yes, there's a little bit of income, there's a little bit of tax because it's interest income, because we have to use the an interest rate, which we use the applicable federal rate. But it's almost negligible, basically.
Well, I think what you said earlier was that you can, if say these properties are in LLC or whatever, you can shelter up to about 90% of the income. Is that accurate?
Yes, because if you're operating as an active LLC.
Okay. So
Yep.
then he would have taxable income of 10% of
Yes,
whatever that is per year.
If he wanted to, yeah. But this guy in particular, it's a whole bunch of, it's the craziest thing. It's a whole bunch of mobile homes. I didn't realize how much you can make off mobile homes. So he's got a slew of them and he's selling them off one by one. But that's all that whole 8 million, what that's worth right now.
So if he shelters 90% up to 90% income coming through an LLC, he still is required to pay the tax on that 10%.
Yeah, he's general partner.
Okay. All right.
It's a 1090. Yeah, it's going to go through the 1065 straight to his personal. So
I
yeah,
see.
and we have a lot of people when they run active businesses. That's the way we set it up. Could they? And I didn't have enough time to go through this in detail, but could they set up a separate trust, a business trust, and run their business through a trust? Yeah, and save a lot more taxes. Yeah, but again, people you're going to need money for food, fun, and fashion. My wife just had to go to field trip with my son to go to the zoo. We can't. That's not a trust expense. So there's reasons why you're going to need money outside the trust. So, but everyone's different. So, well, good questions. Thanks, guys, for staying on. I don't think there is any other questions. Again, you have the link, and everyone will be getting a recording of this when it renders from Zoom, which I was able to make sure it did record this time. Last time we did last week, we had some issues. But anyways, thanks for staying on the call. Make sure to go ahead and book your evaluation call as soon as you can, and we'll see you there, and have a great day.
So Stefan, just one moment. There is only tomorrow 8, 9, and 10. Is that it?
That's what I would do is just refresh it because literally it's probably because I'm getting cold right now because my calendar is booked, and I don't book 2 weeks in advance because I can't do that. So I would just refresh it. But when I send you an email, just reach out to me too. When I send the email to the recording, just send me an email too, and I'll try to find something that works best for your schedule.
Okay. Thank you.
All right. All right, guys, have a good one. Sorry we took so long, but hopefully you guys got a lot of good stuff out of it, and we'll see you soon.
Thank you. Bye-bye.
Thanks.